radar, doing well at this point in time. But let me start with the top gainer. It's BPCL, about 1.35% higher. ICICI Bank, IndusInd Bank, Axis Bank, SBI, HDFC. Oh, they're all doing well. Okay, so today is quite clearly the morning banking day. I don't know if it's something in the RBI outlook, state of the economy outlook that's cheering. There is a rate cut expected, but an initial rate cut is actually bank negative because a lot of their loans are linked to the repo rate, but their deposits will fall when they fall. So initially it's actually a little bit negative, but at the moment the banks are starting pretty high. The other stocks that are doing well, Maruti Suzuki is up about 0.5%, Bajaj Auto. So the auto stocks come in next. I can understand that. If there is a rate cut, these stocks should benefit. So Bajaj Auto and Maruti are up about 0.6. ITC, we got some buys on ITC. That's up about 0.4. Tech stocks, HCL Tech is up, Trent is up. Those are the main stocks that are in the green. I forgot auto stock M&M is also in the green. Among those in the red, Ultratech Cement, well, they've bought a very small company. That can't be much of a reason, but it's down about 0.4. HDFC Life is down about 0.4. Shriram Finance is down a bit. TCS, Ultratech Cement, I told you, Cipla, Tech Mahindra, Tata Consumer, those are the stocks that are slightly in the red. Tech stocks, one would have thought that they would benefit from the cheaper dollar, but of course they are going to lose because of other currencies, like for instance the euro losing. So if you take all the cross-country crosses, the IT companies are not necessarily benefiting because of the currency depreciation. Be that as it may, at the moment there is more green than red on the screen. Mid-caps, anything that stands out for you?
The index is quiet, but there's a lot that's going on beyond the index. Look at 361 Wealth Management. Remember, Deepan was talking about the stock. He actually likes it, but he's a little concerned about overall valuations. Stock is roaring as we speak, about 4% higher. Let me actually do a check on the others in this space as well. No, not so much. I mean, Motilal, for instance, is quiet. Edelweiss, nothing much is happening. Nuvama is up about 0.5%. BSE is not even ₹1 higher. So this is a specific move on 361. It's not like the whole sector is moving as of now. So let's wait and watch and see what's going on. In terms of other newsmakers, Panacea, as I said, because of the news on their vaccines, which they've got a large export order, 5% up over there. EPAC Durables has acknowledged that indeed they are in talks with a Chinese company, and maybe there could be some strategic deal over there where that company comes in and takes a stake. Maybe. I mean, they've just acknowledged that they are talking. The market's already quite excited about that. Share India Securities is one of the entities, along with Grow and Zerodha, which has put money in Metropolitan Stock Exchange. Share India has put in about 60 crores. That stock is up about 3%. On slightly thin volumes. Share India Securities market cap is around 6,300 crores at this point in time. There are other gainers, by the way. Look at Ola, 4.5% higher, and some of the recent listings. They're continuing their fanfare from Tuesday. International Gemological Institute, 5.5% up. Look at Zinca Logistics, 4% higher. Look at something like Sagility. Sagility, I mean, what has happened to the stock?
I know, 5%.
5%. Remember, JP Morgan is looking at a price of 54. It's racing towards that target already with a phenomenal move in December. More names, Afcons, there's Borosil, plenty of action in the broader market beyond the mid-cap index, because the index itself is actually fairly quiet, not doing much. It's all about the Nifty and the Bank Nifty this morning.
Sagility is almost doubling in the month of listing itself.
Yeah,
I mean, it's a phenomenal performance by that stock. As well, as you said, IGI, the Gemological Institute, as well, having a great listing. So some of these new age stocks, or rather new listings, not new age, all of them, are having a good time at this point in time. All the banks, look at the banking index on 8.6%. No, but it's not only that. If you look down the list,
even tier 2 banks,
CSB, JNK, RBL, IDBI, Dhanlakshmi, all of them, very small banks, and all of them doing well. So I am somehow suspecting index management. Mutual funds, everybody is so financial stocks heavy. You have the last 3 days, and then, not too much of last 4 days, okay? 4 working days, and not too much of perhaps heft of trading, volume of trading, a good time perhaps for index management. But I would still think that they would use 30 and 31st for this. At the moment, banking stocks doing well. But with that backdrop of how the markets have opened and the news that the currency is continuing to weaken, 85.25 as we speak. let's invite our market master for the morning, Anand Shah, the head PMS and AIF investments at ICICI Prudential AMC, joins us. Anand, good morning, and thank you very much indeed for joining us. First up, are you all going into cash mode, or are you all in buy mode at this point in time, considering that the market's been kind of losing steam?
Hi, very good morning and season's greetings to all of you in studio and to all the viewers of CNBC TV 18. I think from market's perspective, we are well poised. I think we had a very strong earnings growth rate. You had a strong beta in the market, and obviously the alpha was also great given you had a very wide spread. So unlike 2020 when there was a very narrow moves in the market on the way up, 2020 to 2024 and 21 to 24 has been a very broad based. So I think both the alpha and beta were great. What we are seeing here from here on is, I think, on a back of very strong earnings growth rate, the expectation from beta, the expectation from the earnings growth rate should be far more muted. And to that extent, market can deliver, but it cannot deliver what it has delivered over the last 4 years. Similarly, stock picking is becoming that much more difficult, but it would be the year 2025 and beyond would be year for more stock picking, more bottom up rather than top down. As we speak today, we still find selective ideas which we are putting it in the portfolio, and to that extent, there's no rush to create a lot of cash into the portfolio at this point.
Oh, you all are not into cash. How much would that be anyways?
No, I think as a philosophy, we don't unnecessarily keep a lot of cash. Cash is only basically deploy or change the ideas from one sector to other. So philosophically, we don't.
Okay.
You know what, it seems like Santa is showing up a little late, but he's still showing up on the screen. I mean, these days, when you see this kind of large cap buying, you just think that, oh, wow, it's a sigh of relief, right? That's what's been happening, at least for now. It's all the Bank Nifty and the Nifty this morning. Anand, hi. Good morning, season's greetings, and we wish you a fantastic end of the year and an even better 2025. And before I talk about the market, actually, I want a theoretical question, what we were just debating. This whole business of year-end NAV management, does it still exist? Does it still happen? I mean, we're in the day and age of automatic trading, and a lot of people would be off on the new year. But you tell us, you're working with an asset manager for so long. What to expect in these last few days? Today's buying, for instance, this large cap buying that we're seeing, could it be related to so-called NAV management? What does it really mean?
No, I don't think so. I think as it is, the volumes really dry up, and given that a lot of our FI fund managers would be also on the leave, given that that's a much bigger thing outside India. I think on the thin volumes, you would invariably find the market moves being either way is very strong. As it is, if you see the trend for the last few months, we have been more on domestic buying. You have been seeing SIP inflows, and to that extent, domestics have been generally the buyers. But the good news, and I'm saying it in a good fashion, that's the good news that we had a FI selling, which made sure that the markets are more balanced. There was no wild moves on the way up because of the strong domestic buying, given there was compensating FI selling. It so happened that towards this week, the domestics continue to buy, but FI selling might be a little more.
Exactly. I think that could be one of the reasons that finally, after Christmas, a lot of the FPIs have finally decided to take their holiday, right? So when the domestic buying is coming in, it's not being offset by this wave of selling on a daily basis that we've gotten used to seeing.
Surabhi, it's not fair. You can't ask a mutual fund manager, are you, seeing NAV management? It is like asking Johnny, did you eat sugar? He's going to say, no, Papa. Okay. No, let's, I raised that question from my list. But Anand, more importantly, there has been a lot of buying, obviously, in the new age stocks. Whether it's the Zaggles or the Zomatos, even the Paytms, the PB Fintech, which is not really new, but new age stocks. What's your sense there? They're all fairly valued. Would you still be interested in those kinds of stocks, the Swiggies, Olas, you name it?
I think within our team, we've been very closely watching this space. This is indeed not only new tech and others, but even in unlisted space, we've been seeing quite a lot of action among the retail investors investing heavily into unlisted also. So with my 24 years of experience, I can tell that, there is heightened interest in these companies. People are thinking that this is a very easy business. As I see, and if I have to speak about organized retailing alone, I think we have a war coming up there. It's not only the quick commerce guys. There are traditional modern retail traders, the Amazons and the Flipkarts also, who uh, are getting onto the game of faster delivery. It's not quick commerce, but nevertheless, as I see from a customer's point of view, you're going to get value, you're going to get convenience. And we have seen this in airlines before, we have seen this in telecom before, where we actually got a better quality product, better quality service, at the same time lower price. And that meant really, really difficult times for the equity investors in those areas. And to that extent, it's a little scary where there has been this sort of heightened interest and no questioning on the valuations. When you don't question valuations, we have seen again in the past, in many instances, that's been a very bad news for many shareholders in those areas.
Okay. Okay, let me come to the traditional bunch. That's the underperformer of the year. I mean, if you looked at the top stocks, there's every danger that Reliance, HDFC Bank, Asian Paints, etc., are going to end the year in the red, which would be, according to Hurma's, the first time since 2014 that some of these stocks would be ending in the red. What do you like in this smokestack in the old space?
I think we are looking at only the large caps, and that's why I said 2020. So run up to 2020, we had a very narrow rally into these names you spoke about, and a lot of money flew in those areas. 2020 to 2024, or precisely in last 4 years, it's been more broad-based. So actually, in the old economy also, we have had fabulous returns generated in even as simple as metals, in general manufacturing, manufacturing allied, the cap goods, industrial products. I think there has been a lot of action happening on particularly infrastructure and manufacturing side, and that's where the money is.
Okay. Anand, okay. Yeah, we do have you with us. I thought that feed is dropping. So Anand, now let's start boiling this down to what to do in this market in 2025. Like you're saying that there are a lot of moving parts in terms of international cues, etc. But if we talk about just keeping your head to the ground and looking at interesting opportunities, at least from a medium-term perspective, then what would get top billing from you? Would it be capex? Would it be manufacturing? Would it be pharma? And within that, if you could be more specific in terms of niche themes, a part of consumer, what are you looking at and what excites you as we enter the new year?
Indeed, quite a few ideas there. But before we come to that, I think from the investors' perspective, the expectation should be far more muted. We are entering the areas where we are talking about slowdown in India as well, but slowdown in Europe, slowdown in China, all this is having quite an impact on the earnings growth rate in general. And to that extent, in the next couple of years, we are actually tiding again, and we have to fight against the tide of slowdown in general and a lower earnings growth rate, unlike the last few years. Coming to areas, I think you're always speaking about banking, and banking has been struggling. But when we see risk reward, while there are initial fears of NPAs, especially in the unsecured area, I think still the banks gets our attention at this point of time, given the relative valuations versus ROEs that they generate. Outside that, select manufacturing is what we continue to like. It will be more bottom up than top down. Within consumption, we have been more keen on services. We like more of telecom and more of airlines and travel. That's where incremental spending is happening from the household. The products we've been consuming enough and more. The penetration game might be left in few categories, but otherwise it will be a low growth area. What within the consumption space we believe will grow faster would be the services.
Okay.
Okay. So when you say services, that would be largely, I'm guessing you're saying travel, hospitality. So within consumer, you'll stick to that. Anything else? But for instance, if we look at throwback to this year that's closing out, for instance, Trent was an outlier. We kept talking about how there's pain at the bottom end and, you know, how sort of lower end consumption is not picking up. But look at the Zudio story and look at what that did to Trent. So any thoughts beyond this retailing? And that also starts bringing in some of the newer age stocks, right? Your Zomatos and Swiggies and Nykas. Consumption is becoming far broader than what it traditionally used to be, the traditional staples. So anything beyond the travel and the hospitality side in consumer?
Indeed, I think organized retail is another area which will grow faster than the consumption itself, right? So while the Indians might be continuing to consume the same stuff, they're consuming it differently, or in the way they're purchasing it differently. So organized retail has been there now for more than 2 decades, and we've been shifting the way we are purchasing goods. And no doubt that organized retail can also or will also grow faster than the overall consumption pack. Separately, consumption of financial services. I think the insurance, the asset management company, the broking companies, the capital marketplace, those are the other services which the Indian household been consuming more. I think healthcare, particularly the diagnostics, these are the areas where again the penetration will increase. The amount of money an Indian household will spend on healthcare services also would increase. So, whole gamut. I think education is another one. There might not be many listed plays there, but that's also the areas where the household is spending more for the kids' education.
Okay, just very quickly, Anand, consumer discretionary or consumer FMCG, mass consumption?
No, I think we've been underweight both consumption discretionary as well as FMCG. I think they were a big beneficiaries of China exporting deflation. I think we had a very, very long period of time, very, very benign commodity prices, which allowed them to increase penetration at the same time, not pass on too much inflation to the consumer. I think that's changed. If you see last 4 years, the end product inflation is very high and the consumers are struggling. I think this is happening at the same time, and to that extent, I see, and the margins are at all-time high for many of these companies. So I think this combination of things we believe will not augur well for the earnings growth rate in this area.
Got it.
Muted top line growth rate, muted earnings growth rate, and that's why we're underweight this area.
All right. Got that. Thank you very much. We hope, of course, things change for the consumer and from the consumer as well. Anand Shah, pleasure speaking with you. Have a brilliant 2025.
Thank you so much.
All right, Anand, with that, let's move on. And just a quick pit stop to check the market screen before we introduce our next guest. And the market screen is interesting. It's all about the large caps, but the mid cap index has slipped into the negative. So interesting trends playing out. The advanced decline ratio is still positive, but at a headline level, the mid cap index is showing a tinge of red right now. So that's the index. Let's put up the advanced decline ratio as well, because that's still okay. You've got about over 1,200 stocks that are still advancing. But yeah.
Habits die hard. Rupees 85.26.
That's another trajectory. It's just not stopping. It's moving so
now
quickly.
I think the Reserve Bank is not stepping in. Otherwise, we used to see them break after the first 5 or as it moves towards a round number like 30. But now I think they're letting it drift.
They're letting it go down. Let's see. Lots for the money markets to navigate in 2025 as well once Donald Trump takes office. More on that later. Right now, we're talking about domestic cues and domestic companies. And one company that's had a phenomenal year is KC International. It is one of the top gainers of 2024. The stock has surged a little over 95% in the year that's just now wrapping up. And we've been speaking to Mr. Kejriwal through the year. He's been telling us about the robust order book and the strong outlook. In fact, the company announced orders of just over 1,000 crores in the last few days as well. Mr. Kejriwal, thank you so much for joining in. Season's greetings to you. Wish you a phenomenal end to what's been a good year, I believe, for KC International. So let's actually start there. We've been speaking about this, and I remember in the last conversation, you were telling us how the ordering trends are very, very strong indeed, and you're seeing a big pickup ahead. Is this likely to continue into the last quarter of the year as well? And where do you see the maximum traction when we talk about your order book growth target and your revenue targets? You've been talking about 15 to 20% growth. Which sectors will give you the biggest kicker?
Good morning, Surbi, and season's greeting to you and to your viewers. I think the answer is very clear. It's transmission and distribution. So this year, if you look at our order intake, we got orders of roughly around 17,500 or so. And more than 60%, in fact, 70% is from the transmission business. So very clearly, we are seeing a huge traction in the transmission business, obviously on account of the thrust of the government on new renewables. It's both in India, surprisingly what it's in India, as well as for us in the Middle East. So if you look at our transmission order intake for the year, it's only 40% India. 60% is from the international market.
Okay. Well, Vimal, good morning. Thank you very much for joining us. Well, I want to quote the previous sentences we got from you. You said, have never seen such strong ordering activity in this sector and see further requirement. So at that time, you gave us a forecast, or rather a guidance of 15% revenue growth and I think 7.5% EBITDA margin. Would you want to improve upon that, looking at the optimism in the sector?
Morning, Lata, and good to interact with you after such a long time.
Thank you.
I think on the revenue guidance, we are still where we are at 15%, and I think we will also stick to 15% for the next year. Revenue and margin, I think we should be there. I'm not very sure because there has been a slight delay in some executions on the newer projects. But I think we should be there. But we have also said that next year we should be above 9%. So I think we are pretty happy with what we are seeing. And one question which was there was on Q4. I think clearly there will be a lot of orders which will come in Q4. We already have an order in L1 of more than 5,000 crores. So I think this trend will clearly continue in Q4 as well as in Q1.
Execution slow in some areas, you said. Is this government related? Because when you look at the fiscal numbers, which is what I do for a living, the capex has not been as strong as the budget estimates gave us. Is that the reason why things are not as fast as you would like them to be?
So that is the reason more for the order intake not picking up in our civil business. Okay, we were targeting, say, let's say around 5,000 crores of order intake in civil. We are, I think, around 2,000 or so. Largely because there's hardly any public capex except for on the T&D side, which is not as much government dependent as what Power Grid does and other people do. On the public space, I have not seen much spending happening in probably in any area. So that's one reason for the order intake slowdown on the civil side, which is compensated by the T&D order intake. But on the execution side, I think the biggest challenge which we are still seeing is the shortage of manpower. I think we're still short of 4,000 to 5,000 people across our businesses. Okay, so that's one problem. When I say manpower, it's basically at the technician level. It would be fitters and carpenters and masons and all those people.
Oh, this is very interesting. I think we should make this a national debate. I mean, one would have thought that we would be labor surplus. So clearly there are skill deficiencies in some pockets, labor not of the kind you would want. That's very interesting, Vimal. We'll try and make that a national debate. But now to come back to the more micro point of your Rupur plant, change of government in Bangladesh. How is that progressing? Is it progressing at all? Any worries? Would it be cancelled?
No, we are not directly associated with the plant. We are doing 2 transmission lines there and work is going on. Okay. So as far as we are concerned on the transmission side, we have not been impacted. But Lata, coming back to your earlier point, it's not a question of skill deficiency. It's a question of people not wanting to leave their houses and come and work. Okay. It's an issue. And we have been seeing this right from the day the COVID happened, when you saw the sight of people walking on the roads and all that. So I think that fear is still there in people, and with your Manrega, etc., people do feel that, why should we go out and, work somewhere else where I can get at least a part of it sitting at home or doing a farm work, etc. So I think it's a question of how do we motivate people to leave their homes and come and work on these projects.
Interesting. I mean, those are other challenges that management will have to navigate across the sector.
Actually, it's not Vimal. I heard this even from L&T, not the official spokesman on the channel. But there are people who are complaining that even those who are there are not that motivated. We try to give them pep talk to be more productive. And there is a shortage of
a labor issue, perhaps. Okay. But just to get back to some of the key numbers, Mr. Kejriwal, the last time we met, the numbers we had was order book at around 34,088 crores, and you were L1 in over 8,000 crores of orders. So now as we're almost closing out the year, where does the order book stand? The actual one and the one where, you were already L1?
So the numbers are more or less, the order book remains there it is, because after the last, when we spoke, we have had execution for 2 months. Unfortunately, we have not had too many order conversions from that day, but I think we are expecting some more to come in. So order book plus L1 right now is at 40,000 crores. And our expectation is that the order intake for the year, which is around 17,400 till now, will touch the projected 25,000 crores by March end.
Okay, so 25,000 crores of additional orders by March end and 40,000 crores of order book, including the L1 orders. Now, got that. Mr. Kejriwal, the power is, really moving well for you. We've spoken about T&D. What about railways? Because I remember in the earlier part of the year, that was where you had a bit of a concern. Things were not moving. But that's also a segment that you've been looking at very actively. What is happening with the railways now? And what do you expect in the coming quarter, Q4?
So railway still remains a concern. I think execution is still a problem on the conventional railway side, where blocks, etc., are becoming a big issue. However, what has changed since last time is that there have been a large number of Kavach tenders which have been issued, and government has started awarding them, especially on the loco side and the infra side. So I think that part, which is right now not there in our order book beyond what we were already doing, I think those orders will start coming in maybe this month itself they are talking, or maybe next month we should get some more. So that's the good part of railways, where the Kavach orders and some more technology related projects are coming up. The
And how
conventional
would the
still remains
margins
a
be,
concern.
sir? On Kavach,
Kavach
as in
would
when
be-
these orders come in, how are the margins?
Kavach would be slightly higher than the conventional margins because it's a technology product. It would surely be around double digit or so. The challenge remains on the conventional and also some part on the cash flows. I think railways has been having some cash flow issues, and I think that's a challenge which is also slowing down some execution.
Okay. Well, we leave it at that, Vimal. Thank you very much on behalf of your investors for giving them such a glorious year. And here's wishing you that 2025 is equally or, in fact, more successful. Okay, we have to take a break on that note. We've been updating you on the markets, and it's, as Surabhi has been pointing out, it's been so far a good day, at least for the big stocks. Mid-caps a tad in the red. We're going to take a break and come back with another winner of 2024, none other than Motilal Oswal Financial Services. Welcome back. Like we've been telling you, big stocks in the green at this point in time, big indexes, especially the Bank Nifty. Mid caps just dibbly-dobbly, a little bit in the red. But we are in that mood to look at the winners of 2024. Motilal Oswal Financial Services is one of the top gainers of 2024. The stock has surged more than 190% in 2024. In fact, the broking company Investec is positive on Motilal Oswal, and they believe that all operating businesses are well positioned and are gaining market share. To discuss more on this, we have with us Shalibhadra Shah, the Chief Financial Officer at Motilal Oswal. I don't know if I'm pronouncing your name properly. Feel free to correct me. But I just wanted to know, what are the trends that y'all are getting? Do you think you can continue with this kind of customer acquisition and market share growth? Is the visibility clear?
Good morning, Lata, and my name is correctly pronounced.
Okay,
thank you. And I think it's what we have seen first half of this year. It's an all-round performance, in terms of our whether the brokerage business or our asset management business, our private wealth business, alternate business, investment banking, and so on. And there is a very healthy trend in the industry overall. If you see the run rates of client addition, still monthly demand account continues to be very strong at almost about 3.5 to 4 million demand accounts getting added in the industry. Mutual fund SIP book has been very, very strong at almost about 25,000 crores a month. Even the overall folio addition has been strong. Primary issuances have been strong. So we are seeing a very, very strong retailization story playing out. And in fact, with the entire financialization of savings happening very sharply, which has actually moved towards the equity culture, we are very optimistic on the overall financialization theme to play out for next few years. And in terms of even the client additions and the assets, I think we expect strong asset addition, client addition to the momentum to continue in the future as well.
No, absolutely. Shailbhadra, I mean, we hear it from Mr. Ramdev Agrawal himself, right? He's so optimistic on the capital market segment, has been for a while. And obviously, I mean, he sees that in his own business. I'm sure sort of that's where it's coming from. But let me ask you this before we move on to other issues. It's been a phenomenal year so far in terms of, average daily turnover, client additions, etc. But what do you forecast in terms of these trends, say in Q4? The market's now entered a consolidation phase. The first quarter of consolidation was this October, November, December period. If the market continues to be in a time correction, I'm not even talking about a price correction right now, but if this continues, then what is the pace of, client additions, turnover? What can you forecast for, say, Q4 or, say, the second half of this year?
Yeah. While there is a bit of consolidation in the equity markets, but there is a lot of traction, on some of our businesses like asset management, private wealth management, and on. Because, see, again, what we are looking at is very healthy trends where the performance is there. Because to take an example, our asset management business, almost the entire AUM has outperformed the market, right? And the industry flows, we are getting a very large pie of that, which has led to even improvement in our market share and flows trend. So we expect a lot of traction built in our asset management business. Even on the private wealth business, we have very healthy pipeline of, the family offices that have added, the kind of product innovation we have done, a lot of senior talent we continue to add in that business, advisors we are continuously adding. So these businesses actually continue to see the benefit of even the strong equity culture. So flow run rates have been very sharp. So we believe H2 will be very strong flow run rate in these businesses going. This broking business again is of course is a function of markets, but again what we are seeing there also is a lot of focus on the distribution business where we have deepened the modes to cross-sell to the brokerage clients. And we see good momentum across these segments.
So, let me ask you, if at all, if you can give a numerical sort of a projection. We take your point completely. What you're saying is wealth management is really offsetting any kind of cyclicality which the broking business will throw in, which is the nature of that business, right? And wealth has been doing very well. It's a large business now for Motilal Oswal. Some estimates on the street say that you can deliver a PAT CAGR of 31% between FY24 and 27, and an ROE of 25%. These are the kind of estimates that analysts are working with right now. Do they seem fair? You tell us, given the strength of the other businesses, on a CAGR basis, top line, and say PAT CAGR, what can we expect?
See, I think overall, if we look at the growth in last 2-3 years, the PAT growth has been almost about 40%, right? CAGR over last 2-3 years. And even this financial year, first half, we've grown at 47% in the first half in terms of the profit growth. So we expect a strong growth trajectory because the pipeline of business I was talking is very heavy. So we expect this trend for next 2-3 years to deliver stronger profit performance. So again, we can't predict an exact number, but I think as I was talking, the momentum is very, very strong. And even last decade, we have delivered, 34% operating profit performance. Rest aside, keeping the treasury book aside. So we expect meaningful momentum to continue for next 2-3 years of trend. Given
there is, Shalibhadra, there is one always risk factor that is mentioned everywhere. Past performance is not a guarantee of future performance. Okay, let me just twist the question a bit. We've seen Grow and Zerodha just take away business from traditional brokerage houses, and that's led a traditional brokerage house like Angel to actually launch a new service. So from y'all, will we see any such fresh launches, or will we see any demerger of business to take advantage of the mood of the market? For instance, like housing loans or something like that. Will we see another listing?
So at this juncture, as of now, we have no plans to list business because we see this as entirely one synergistic business opportunity, whether it is our brokerage business or our asset management or private wealth or investment banking or institutional equity, alternate business. All of these plays a very strong synergy within themselves. And, the capital needs for this business are met by us by a very strong treasury book, because that's a very differentiated twin model business of operating business and a treasury book which takes care of all our capital needs for each of the operating business. So unless we decide to dilute, we have no plans to actually demerge these businesses, because these are very synergistic opportunities within themselves.
Okay. Got that. We'll let you go. We have still a lot more questions, but time is short. We will touch base with you in the new year. Thank you very much, Shalibhadra. Have a great 2025.
Thank you. Thank you.
All right. We've been discussing about outlook with everyone who's come in, but let's also look at the year that was. In our year-ender series, Nigel is looking at the cement sector. It witnessed a significant amount of consolidation. Nigel, tell us, how would you decode the year that was and how things will pan out in 2025?
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and UltraTech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as UltraTech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, And urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
Well, that is what the market is sort of hoping for and perhaps expecting. That was Nigel there with the sector dynamics. So let's ask our next guest if these hopes will actually come through or not. Sandeep Ghosh, Managing Director and CEO at Birla Corporation, is with us now. Thank you very much for joining in, Mr. Ghosh, and season's greetings to you as well. So let me just start there, right? If you look at broker estimates, as Nigel was summing up many of them, the expectation is that some of the recent price hikes that have been announced just in the last couple of weeks, that maybe they will hold. They'll not have to be rolled back. You tell us, what are you seeing around you? And, have you taken any price hikes in this quarter? And what do you expect on pricing over the next, say, couple of fortnights?
Thank you, and season's greeting to you as well. I tend to agree a lot with Nigel's assessment, which he has kind of, I think, consolidated the industry, the broker's overview, and the channel checks. I think this is more balanced than what we were hearing earlier when there was undue, I think, optimism to think that there'll be a huge hockey stick in the end of third quarter and the fourth quarter, etc. So that'll change. I think now people are taking a much more realistic view. Only where I have first let me answer your question about price increases. Yes, the prices have moved up by and large in most regions, except so much in the south. And the increase is modest, though. I would place the increase between 5 to 7 rupees a bag, which is, say, around 150 rupees a ton. So that is there, and I do expect it to be to hold on, and especially things should pick up further in January once both the cold recedes, and then there is also this whole impact in the north of what they call the Malmas. During mid-December to mid-January, there are no new constructions, particularly in the individual home sector, which start. So that should change, but as yet, I don't see a run in the demand, but certainly the current momentum will hold. And again, to complete the point, I am particularly looking at the budget at the end of next month, which is hardly a month away. I think that is going to impact the sector a lot because the interim budget, though it made announcements, some of it did not materialize, translate into actual impact on the ground because of elections and various other factors in between. But if the new budget comes in and if there is actually a thrust from the government, as well as with most of the critical state governments in place, they would be, they'll be fully in the saddle by then. And by being fully in the saddle is essentially when they start sanctioning expenditure, releasing funds. The earlier, priority of diverting funds to pure welfare schemes, that'll recede. And so there'll be more expenditure on the development front, especially in rural developments. All those augur well. Where I have a slight difference from Nigel's analysis or everybody, I think the impact of consolidation is highly overstated. I personally am a great believer in the demand factor. Unless demand picks up, nothing else holds. And for that, capacity utilization of the industry, that is critical. So the pricing power, which people talk of giants, etc., I think that is largely exaggerated. So once your demand picks up, goes to higher 70s, that's when you really see a buoyancy and attraction in prices. And whether that happens or not, we have to wait and watch. The large players, again, I think instead of exercising pricing power, they will be greatly focused on costs. Especially one of the large players is, focusing a great deal on the supply chain, doing major disruptive, changes, moves in the supply chain because they have, and that is as per their stated policy. So you will see a lot more focus coming in on cost savings rather than taking huge price increases. That's my overall assessment.
Oh, that's an excellent
FY26 is looks better than what FY25 and FY24 second half was.
Okay. So that's an excellent overview of what is to come. You've touched on all the major themes that I was wanting to ask you on. But just to needle point things a little more, do you get maximum demand from government capex, that is bridges and infrastructure? Or I was under the impression that a bulk of the demand actually comes from housing. And real estate, urban real estate at least, was doing reasonably well in the year gone by. Can you just tell us, where do you see
urban
the major demand?
Urban real estate is highly overstated. That's a very small significant. The two major components of cement demand, you're right, is 40% approximately comes from the infra, or what is in our terminology we call the non-trade segment, okay, which is B2B, but B2B is essentially large infra investment, and some of it is large projects, could be real estate, etc. But the real driver of cement business still in our country is what is called the individual home builder. And individual home builders comprise largely rural demand. And in rural demand, again, you have the infrastructure component, something like the PMAY, Pradhan Mantri Awas Yojana. That was a huge driver for many years. Okay, and then the rural infra, which is where the state governments have to spend money. And much of these things happen really in tandem and between the center and the state, because as you know, many of the schemes, the central schemes have a state contribution. So until unless the state put an equal amount of money, the center doesn't put in their bit. And so here, quote unquote, I'm not making a political statement, but the so-called double engine comes into play.
Okay. Yeah, no, we had a very good report from the Reserve Bank on state finances, and they have also highlighted that the money that's coming from the center comes with a lot of conditions, and that the central schemes also crowd out a lot of independent spending by the states. So there is something to say even for the state government's willingness but inability to spend. Be that as it may, do you expect that in the coming year, you are going to see, do you see bids, tenders, etc. of state government spend?
First of all, infra, the central government spend will be really big ticket.
Okay.
Okay. And not as much as I would think the state government, because as you know...
No, my big worry is, the center...
If I just complete this...
Yeah.
A lot of the state government spends, as you and I know, have now been diverted to welfare funds. Okay. So some of the state governments are really cash trapped.
Okay.
Okay, so that becomes a constraint. So when you're talking about that non-trade infra segment, that will be driven largely by the big central projects.
Sure. So, Mr. Ghosh, let's wind it down. We've understood the macro positioning of the sector very beautifully, thanks to you. Let's wind it down with an outlook specifically for Birla Corp. You had told us that the second half will be better, and you were expecting a recovery in EBITDA per ton. I think first half you were at 532 as per the numbers that I have with me. So what would be EBITDA per ton, second half, the recovery? And for overall, I mean, for FY25, what would the picture be on volumes?
You've got me at a very wrong time, because we are in the silent period. In any case, we don't talk about company-specific things on, on a fora like this. But we are not changing any of our guidance, which we have given earlier.
Okay. All right. So I'll just reiterate for the benefit of our viewers. The guidance did say that, the financials in the EBITDA per ton will improve in the second half, and, it should get better from here on. Thank you very much, Mr. Ghosh, for joining in. This was a very, very helpful conversation. It really gave us a wonderful broad context to the sector. And here's hoping indeed that FY26 and calendar year 25 is better for the cement space. And season's greetings. And once again, very happy new year to you as well. Well, with that, we have to take a very quick break. Come back on the other side. We'll take stock of the market once again and also look at what's happening in commodities. We'll have Manisha joining in with the latest.
Welcome back. The markets have not been able to hold on to their early morning gains. A bit of profit taking coming in, and now the Sensex and Nifty are also in flat terrain. May dip into the red any moment now. Mitesh Thakkar joins us precisely at this point to give us some advice. Mitesh, any sell call now, or is it a buy on dips, stocks?
Morning again, Lata. I think early in the morning also my view was to sell on rallies, and I think the 200 average, which is at about 23,870, I think came into play. We got a high of 23,850. I think that was the selling zone, so it's working well. Right now I have two sell calls. One is Bombay Stock Exchange or BSE. I think it's had a very good rally and now showing first signs of profit booking. So keep a stop about 54.80 and look for a target of around 5,200 or below. And the other one is JSW Energy, which is a conditional sell. There's a support pivot at about 640, 639. So sell below 639 with a stop at about 655 for targets of roughly around 610.
Okay. Thank you very much, Mitesh, for that. And we will touch base with you, of course, later on in the afternoon. With that, let's shift focus to the commodity market space. And Manisha is actually hitting the nail on the head. She's trying to wake us up all with a cup of coffee. Tell us,
Well,
Manisha.
absolutely. You know, Lata, next week you would want it more because we are working on 31st and 1st as well, while most international markets are not. But for India, well, yes, the demand is expected to go higher. And if you look at the prices in this year, well, we've done exceptionally well for the producers, of course, not for consumers. So the Arabica coffee prices are trading near record highs at around $3.2 a pound. This is the prices that are trading in today. And the all-time highs also have been seen in the month of December at $3.5 a pound. That was recorded on December of 10th. So if you look at the prices on where they are, we've seen 70% of gains in case of Arabica prices. This is the highest that we've seen in 1977. And if you don't drink Arabica, but Robusta is a coffee of your choice, well, there's no respite there as well, because the Robusta prices also have gained up by 90% in 2024. We've seen prices double up in this current year itself. Well, there are a lot of reasons that we have seen prices gain up. One, there has been adverse weather conditions in most of the producing countries, including Brazil and Vietnam. Much of the coffee, whether it's Arabica or Robusta, is produced between these two countries there. Apart from that, it has been about below average rainfall in Brazil, which produces 70% of Arabica for the world there. In Minas Gerais, that is where most of the coffee is produced, we have seen disruption in crop growth as well. There have been concerns in sense of inventories there as well, and that has been keeping prices higher. There also are reports that for 2025 and 26 as well, it could be a fifth straight year of deficit. There are concerns of 5% crop shortfall into that one too. There also is a report from World Cafe, which by the way is the largest coffee trader in the world, saying that the Brazil Arabica production could decline by 11 million bags to 34.4 million there. There also are strong global consumption numbers. And while the fundamentals are on the stronger side, you also are looking at a lot of speculative money riding on this run as well. And most coffee chains by now have raised their prices and expected to do more in 2025 as well. The markets also are looking at concerns when it comes to transport facilities, higher freight costs. And then there are various reports on how producers are holding on to whatever coffee stocks they have. They expect better prices in 2025 as well. So it's going to be yet another year where you will be looking at higher coffee prices.
Okay, that's not good. That's not at all good, Manisha. I'm like quite an addict. But anyway, we have to take what we get. Let's shift focus from coffee and commodities back to stocks and equities. We've got Sudarshan joining in. Sudarshan, you told us about Ola Electric and its launches. Remind us what's the big news and what can it do to the stock?
So the stock has come off opening highs. At one point was up 6%, but still it's still higher in the trade and up around 2%. And the reason of this is Ola has increased the number of stores. Now it's at 4,000. So in one go, company has added more than 3,200 stores. But why is it positive today? The reason that in one go it has added 3,200 stores, and these new stores are co-located with service centers. If you remember, company has been facing issues related to service center. So in these new stores, company has added this facility. So it might help resolve the issue related to service. Apart from this, company has also announced the Move operating system 5 beta version, and with the facilities like group navigation and live location sharing, and also it has launched limited edition of Ola S1 Pro Sona, and company claims that it is launched with real 24-karat gold-plated elements. But major positive part is addition of 3,200 stores and co-located with service center. That's the reason stock is positive today.
All right, got that, Sudarshan. Thank you very much indeed for giving us all those details yet again. So higher capex perhaps in new stores is hurting the stock at this point in time, but actually the whole market is hurting somewhat. I must point out to you that at the moment the advanced declines has turned in favor of the declines, as you can see. We at least started off with the green line. The advance is ahead by a margin. But as you can now see, the declines have overtaken and the ratio is increasing in favor of declines. That's a bit negative for the broader market as well. We have to take a break, but after that, we move away from the micros to the macro India story. Well, how will 2025 pan out? Is it going to be a tad better than the current year? Will the Trump taxes be a little positive or less negative for India than other EMs? All those questions to a bunch of economists who will be joining us on Outlook 2025. Welcome back to our Outlook 2025 series. The Reserve Bank has just cut its GDP forecast for the fourth quarter to 6.5% from 7.2% that came in the December bulletin. But how are economists taking this revision and how do they see calendar 2025 and FY26? Joining me are two economists, Devendra Kumar Pant, the chief economist at India Ratings and Research, and Aditi Nair, the chief economist at ICRA. Aditi, Mr. Pant, thank you very much indeed for joining us. Well, Dr. Pant, let me start with you. I read up your report and you are expecting the Indian economy to grow at just 6.6% in FY26 as well. Would there not be some cheer from the fact that we have a good harvest and there is going to be some at least liquidity loosening by the Reserve Bank? Won't all this mean better times for FY26?
Well, Lata, I hope I am in the same camp as you are. As of now, how the situation is. Look, liquidity impacts people at the top end of the spectrum. Now, what we are concerned with, earlier we were concerned with the rural demand. Now we are concerned with the urban demand. Until unless inflation comes down sharp and stays at around say 4.5%, more than the liquidity, which will have an impact, the overall inflation decline will have a larger impact on the on the consumption, and so to say on the overall demand in the economy. We don't know how the monsoon is going to pan out in 2025. As of now, like Aditi or any other forecaster, everybody assumes with a normal rainfall, and it's only around June or so we have more idea about how the rainfall is taking place. We don't know how the weather pattern is going to evolve during this February and March. Will it be heat, more hotter condition compared to normal? Will there be excess rain? Will there be hailstorm? So that we are so hopeful about the good Rabi forecast after the output. If that doesn't happen, then even 6.6 will be a problem. Moreover, how from 20th January 2025 the entire landscape is going to change? Will there be a tariff war? There will be tariff increase. Now, how the commodities are going to behave? Whether how the capital flight will inflows or where there will be positive inflows or whether there will be capital flight. So there are so many unknowns. So based on that, we have looked at 6.6, but any of these 3-4 things which I mentioned, if that materializes, then I'm afraid there could be a downward revision. But what government can do, that is a big challenge. And when we talk about government, we generally focus or fixated about the union government. We have to go and look at what each state governments are doing.
Fair enough.
Because if we talk about government capex, union government capex, 11,11,100 crore. A large part of his defense capex. That does not create much demand in the economy. So we have to see those things, how they are going to pan out in next year. And based on that, there may be a revision. Which way? As of now, we can't say.
Yeah. I read your report. You did say that gross fixed, government expenditure as well as private expenditure is likely to remain muted in FY26 as well. But Aditi, Dr. Pant has clearly raised the issue of consumption, of inflation bringing down consumption. That naturally focuses on what you expect from the Reserve Bank in calendar 2025. After reading the bulletin, did you get a feel that a February cut is on the cards? What is the cutting cycle at all? Is it 25, 50, 75?
Lata, if I may just add a couple of points to what Dr. Pant just said. I think one of the reasons why we're a little more hopeful of rural sentiment remaining a little more sustainably intact in the coming year is that the reservoir levels are actually quite good in most regions. And this is something that takes away a lot of the uncertainty related to particularly things like the onset of the monsoon rainfall and how that pans out in the first month or two. So as you know, July is the main month for sowing. And when reservoir levels are quite healthy, then at least we are less concerned about how exactly when the monsoon onset is and how the first 5 to 6 weeks look. So that's one positive. Second is a kind of odd thing that I'm going to say. We are now becoming more apprehensive of a larger shortfall in capital spending this year from the Government of India as compared to that 11 trillion budget that Dr. Pant just mentioned. And that would probably give us higher headroom to show a slightly, kind of mid or double-digit growth in FY26 while remaining within the likely fiscal contours. We do think that the government will try and target a 4.5% fiscal deficit to GDP ratio. And with smaller capex becoming more and more likely with every month of data that we're getting from the Government of India, there would actually be higher headroom to grow next year. So that's a positive. But global risks abound. I mean, this is certainly one year where we're very clear that we're looking at a lot of global uncertainty and global risks. And that is something that is going to add a very wide range around baselines for all economists. Now, coming to the RBI, my sense is that it's really going to be the December CPI data point, which is going to be very, very important, which is going to dictate whether the MPC can move ahead, a kind of new look MPC in a sense, can move ahead with a Feb rate cut. Other than that, in terms of the cycle itself, we still think it's going to be a very shallow cycle, 50 basis points spread over two policies.
Okay. All right. Let me just correct what I said about Dr. Pant. The government final consumption expenditure is expected to be only 4.3, but they are expecting personal consumption to improve to 6.9% in FY26. Where will this improvement come from? Will it be urban, Dr. Pant?
Well, if it is, if the inflation pans out the way we are looking at, and our estimate is for this year 4.9, and next year it is likely to be 4.3%, then we will see that likely to see across the board. It can come both from the rural as well as urban. But for rural to happen, or to consumption to grow, the 2025 monsoon is very critical. Not only overall, it's spread over space and over time. That will become very critical. If that happens, then I think both rural and urban will contribute compared to the 2024 or FY25.
Yeah. No, I take your point that, as economists and, of course, data journalists, we should start factoring in the climate impact. After all, what took away from the second quarter growth was this extra rains in August and the terrible summer that we had. So climate impinging and taking away growth is going to be an important, probably vertical in economics, which is as yet underdeveloped across the world. But Aditi, should we expect something from the budget? Reform orientation? After all, one meeting with economists is over, both with the Prime Minister himself and the Finance Minister. What would your best guesses be?
Lata, my best sense for this budget is that, what I'm really looking forward to is the unveiling of the new medium-term fiscal consolidation plan. As we all know, for this year, the government is targeting a fiscal deficit of 4.9% of GDP, and we expect it to be mildly undershot because of a shortfall in capital expenditure. For next year, the medium-term target was to get to 4.5% of GDP or below, and we expect it to be right around that level in terms of the budget estimate itself that the government puts out. But then we need to look at the fresh medium term, the next 5 years. What exactly is the government targeting? They've indicated that they want to move away from a fiscal deficit target to a debt to GDP target. So what are the contours of that going to look like? And again, coming back to what you were just saying, how are we going to build in, the new